Welcome to Altus Insights Podcast series with Ray and Marlon, hosted by me, Avi. This podcast will cover monthly market updates and construction cost impacts across major markets in Canada.
I love having our dog in. Let's switch over to industrial. So every conference that we attend now, we keep talking about headwinds on industrial, even though very low vacancy rates, 10-20% increase in rents. What type of headwinds do you guys anticipate, or if any, on the industrial side? This time, Phil, why don't you take a start at this one?
Sure. Look, it's hard to find any, but I mean, I think the big one would just be the cyclical headwinds. I mean, industrial is now more consumer driven than it ever has been before, and so I can't imagine that the pace of leasing activity that we've seen over the last few years, is going to continue into this, what is most certainly a slower economic growth environment, right? Now, over the long term, I would say, most of the leasing decisions are less probably cyclically driven than, say, when you've got this, massive backdrop of population growth that we've seen in Canada. But it's certainly going to impact when decisions are made. And so I think, heading into this year, I think we're going to see leasing activity slow. But to what extent, I don't know. I think you look at the fundamental picture, and it really is just a tremendous environment here where we just can't build enough industrial space right now. So I was looking at the other day data from new construction, under construction in the U.S. And if you look at Dallas, for example, 55 million square feet under construction. In all of Canada, there's 42 million square feet under construction, right? So that's, pretty incredible. I mean, even if you look at the size of all of Texas, for example, you're about 30 million compared to Canada's 39. But, and as a percentage, that Dallas market is still, I think, only 5 or 6% of stock under construction, but Canada were about just a little over 2%, right? And vacancy is under 1%, and most of that supply that is under construction right now is pre-leased, and so I think to get back to a balanced market, we would need to see some pretty significant negative absorption happen, and I just don't see it. In anytime soon. And so I expect, rent growth to continue, certainly not at the pace it has been. And returns have been absolutely fantastic. It's been the best performing asset class of any in history. Again, looking at private real estate returns in Canada, but it'll slow. It has to normalize from these heights for sure.
Yeah, I think what I might add is where we see, headwinds, it's not as much on the investment side. It's really what is going to impact the tenants. So, a recession may impact some of the tenants, especially small bay. But our experience with small bay during downturns is that we've always really liked it for the fact that if one tenant can't make it because of economic conditions, there are other people starting businesses. There are other businesses out there that need to expand or maybe contract, but go into a smaller space. So we've never had problems in downturns keeping the small bay leased. So we're liking that. The cost of fuel is one that's coming up for some of our logistics tenants that may impact them as much or more than some of the interest rates and inflation. So that's also something keeping an eye on is location dynamics. So we may start seeing, maybe a bit of change in terms of location of industrial. So closer to where probably the consumer base, most logistics is trying to get to, whether they're trying to get to stores or they're trying to get to end users, the proximity there, and for labor to get to their facilities. So that's one thing we're watching for. But to Phil's point, there's such a limited supply in Canada, especially MTV markets. The supply is low, the demand is strong, and that's a difference with Texas, where they can just keep expanding. There's a lot fewer restrictions to just expanding on and on. I used to live in Texas. Sometimes it does feel like you can just drive forever, and there's very similar looking landscape, which is not the case in the Canadian markets. So I think we're have with those kind of constraints, there's always going to be less supply being built. And, but we, obviously we like that asset class. We agree with Phil that the rent growth that we've had more recently, it's not going to keep growing at that pace. It's unlikely to keep growing at that pace, but because there was a lot of catch up to do compared to other North American markets, which is largely done, but it's still a really fantastic asset class going forward.
Yeah, and I think we've still got more room to run on the e-commerce side. Penetration is, call it probably mid-teens. Again, it depends on what data set you're looking at. But if you look at it in comparison to the US and some Western European markets and that, we're still lagging a bit behind there. So we've still got some room before we see more maturation in that. Interestingly, just looking at StatsCan data on e-commerce too, we've seen, after a bit of a pullback from the sort of the heights of the pandemic in terms of what was being bought online, we've now started to see that accelerate a little bit as well. So, we'll see. I think there's still some retooling of supply chains that need to happen for many retailers to accommodate that growth in that area.
Yeah, I was going to say, to add to that, I think just that switching global supply chains to, instead of just in time to just in case, and, onshoring or putting in within Canada, within North America, more of the supply chain. So that's creating demand for more product, bringing product in earlier than they might have otherwise brought it in. That's creating, certainly it's intriguing. There's more opportunity in Calgary and Edmonton to be some of that, we'll call it back of house storage for Toronto and Vancouver, where there's a little bit more supply available, and a little more opportunity to add quickly some industrial supply. So I think that's, to me, that's somewhat of an intriguing shift in Canada, whether it's for e-commerce and it's an initial point, or it's more for, durable goods fulfillment, so your appliances and so forth.
I think that's one area, like, again, if not necessarily a headwind, but maybe just not as much of a tailwind as maybe is being made out in the media is onshoring and reshoring. Like, I haven't seen any good data on that to see that that's actually transpiring to the extent it maybe hits the headlines, at least in Canada anyways. I could certainly see a significant impact in the southern US and into Mexico, but it'd be interesting to see how much of that is transpiring in Canada, outside of, say, pharmaceutical and other products that are sort of essential or have been deemed now essential since the pandemic. So that would be maybe less of a tailwind than I think many are maybe suggesting.
Yeah, interesting. Well, I think it's the manufacturing to come to Canada doesn't make as much sense as getting goods here earlier, not days before they're needed, but potentially weeks and months before they're needed. And that takes more supply. But to your point, what products are going to be stored here on a longer time frame, and how much space? But I think there's still a tailwind there. But I do agree, it's to what extent, how big is it? Mexico's tailwind is probably far larger. If you do industrial in northern Mexico, there's probably a much bigger tailwind there.
Yeah, I think the other indicator that we haven't seen here yet, but we've seen in New Jersey, is how parking lots are being used up in some of the industrial areas to store trailers. Right, we haven't seen that extent yet. That there's not a market for to rent out sort of vacant land and use as storage. The other thing, Phil, with your comment earlier in regards to U.S. industrial, I think they allow for a little bit, speculative construction compared to Canada, whereby it's next to nil, whereby most of that space is leased up before actual completion, right? So when you look at the industrial market, so I think the turn is toward technology, super flat floors and higher ceilings and fully automation. You have these dark industrial buildings whereby you just have products. You basically have nobody in the warehouse that's our pickers, and they do a lot quicker compared to workers. So there's that shift, probably because of the labor shortage, to be more efficient in that respect. So what we saw in the U.S., especially in the spring of this year with Amazon's announcement, that they were either not renewing or selling some of their assets, were reflective of the older product and trying to be more efficient with some of their newer buildings. Are you seeing some of that? Like, how do you think that this being handled with a large logistic demand such as Walmart and Amazon? Are we seeing continued push for the bigger box than what we're seeing now in industrial?
Yeah, I think that's certainly the trend. I think that we've been seeing that sort of transpire over a number of recent years. I wonder how much more efficiency can be sort of churned within the box right now. I think that's that could be a headwind, at least for a pause in absorption from some of those large users. And I'm thinking more so Amazon specifically. Like it'll be interesting to see what they can extract out of their existing facilities as there is greater demand for product. Again, we've got tremendous population growth, G7 leading population growth, which is expected to continue with increased federal immigration targets, both on the permanent residents and non-permanent residents. We're expecting a little over 1.5 million newcomers to Canada in the next 3 years. So, you can only get so much efficiency out of that existing space before you have to kind of continue to expand again. Hard to tell right now. But I think, longer term, there's still quite a bit of runway there.
Yeah. I think also what's driving some of this is thinking about labor shortages. Even, we are bringing in all these people, but there's more people retiring than we're bringing in. So we're still in this net deficit. So, and I think, the logistics companies, e-commerce companies are struggling to fill some of those jobs. So obviously the automation in warehouses is key to be, not needing as many pickers. And then, but also truckers, people to drive trucks and delivery has been a challenge for them. So anything they can do to try to automate the process, I think is going to be a driver of some of the decision making, as well as, as I said, maybe closer to where the customers are, so you don't need to have as many vehicle miles traveled and labor hours used to deliver goods.
Well, that's where it kind of becomes interesting in looking at medium longer term is and that onshoring reshoring element of it is if you take out the labor component. Where that's really the reason why you're not able to compete in Canada versus Southern US or Mexico. But if more of it is automated and you can work 24/7 around the clock, I think it kind of brings Canadian markets into more into competition than they otherwise would from that labor perspective. So that's another interesting kind of dynamic around it.
Yeah, we need to turn to multi-res, and we have to touch upon this because this is Wendy's special. She's a specialist in this area. Wendy, what's your take on the multi-res? Are we going to still see continued higher rental rate push and continue supply issues in this area?
Well, we just got a huge supply-demand imbalance in the major cities in Canada. As we just mentioned, we're adding, between permanent and non-permanent residents, it's going to work out to about just over 1.5 million over the next 3 years of people. They need a place to live. They're coming to Canada. About 60% of the new permanent residents are economic immigrants, so they're coming for jobs, increasingly quite well-paying jobs. We all know that the tech companies bring in people to Canada because they can't hire into the US. It's easier to bring people into Canada, but there's a whole wide range of skills that people have. And one of the things that our research has shown is that their incomes are up. We only have data to 2019, but incomes of new permanent residents 1 year after their arrival was up 62% in a decade. A median income in 2019 of about $47,000. You could gross that up to today, and it's probably slightly over $50,000. But if you put people into a couple, put them into two, and this is for 25 to 34-year-olds, you can afford new product rents. So we've got more people coming. They do have some housing pricing or spending power that we're definitely seeing in new purpose-built rental. We're seeing this group in. So we're definitely on a lot of tailwinds for the sector. The challenge is, of course, we just don't have enough housing. So it's going to be a very large challenge for our economy We need more rental. We need more ownership. We need more housing of all types.
Okay, Bill?
Yeah, I think it's interesting right now. I think, it's multifamily rents have been on a tremendous run coming out of the pandemic. As the labor market's improved, you've had a, return to downtown. I wonder too, like in certain select submarkets, I think we may be kind of coming up upon a limit on affordability. But as Wendy mentioned, you've got some pretty tremendous wage growth actually in certain segments of the market. The young professionals that have the skills and the academic credentials that are in high demand, particularly in tech, even, despite some of those headwinds. It's actually an opportunity, I think, for a lot of other industries to compete for some of that talent now. So I think that wage growth story is helping for sure. But I think it'll be interesting to see once we do have a bit of correction going on in the housing market right now. Again, with the cost of mortgages skyrocketing over the past year and a half or so, I think the average mortgage payment for a downtown Toronto condo has increased about 60% in the last year and a half or so. So right now, affordability is still very constrained, but pricing of homes is coming off, and so we had this wide gap between rents and carrying costs for home ownership, and now I think you'll start to see that converge closer to sort of long-term averages. But I think over the longer term, look, we've got a bit of we've got some supply coming on the market in the next, call it 12 to 24 months. But beyond that, it tapers off pretty quickly, and we're not seeing the same level of new starts that we've been used to over the past few years. And so once you get out beyond, call it 2 to 3 years, that long-term supply deficit that Wendy mentioned, I think, just continues to get worse absent some significant boosts elsewhere.
Yeah, I was going to say, like, even though we've had, Toronto, for example, has finally had some, record level of starts in the city over the last 10, 15, 20 years on purpose-built rental. But it worked out to, if you actually net out the completion, the total net new supply using the CMHC data, because some obviously gets torn down in order to build new. In say 2019, before the pandemic, we had 1,500 net new units and 50,000 new people 25 to 34 years old in Toronto. So this is people aging in place into that age category and newcomers coming in. So that's, a really bad ratio, 1,500 people, 1,500 units, 50,000 people. And so we've, probably got a few years of, again, similar, we at least had fewer net new people for a couple of years because of borders being closed and a bit of a flow, an interprovincial flow. But we still had more net new people than net new housing and net new rental housing in the GTA. Vancouver, not quite as bad, but 1,500 new units, 1/3 the size, but only 20,000 new 25 to 34-year-olds in that same year, which was the strongest year we've had in a while. So, we've been getting worse steadily. And now, to Phil's point, though, we've got a challenge because there's fewer starts happening, especially on rental, the cost of construction financing, the cost of just, buying land, getting land into production. Construction costs have been rising, so that was making it hard for a pro forma to work. Obviously we're hopeful during the next little while as projects finish, there'll be some construction trades available, and that might at least take the pressure off the upward pricing on labor. But there's some challenges to get housing built in the next few years, and which worry me because we've got such a deficit to start with, and it's going to be looking a lot worse a few years out if we don't change that.
No, I was just going to add, I think it's important too to differentiate too between, again, Toronto, which is heavily dependent on the shadow supply, the condo market, versus purpose-built rental. And I think the supply deficit is even more pronounced in purpose-built rental. And I think the pandemic has only really kind of shone a light on both security of tenure and professional management that multifamily can offer versus the condo market. So I think there's even more of a challenge there in bringing that new supply to market.
Yeah, I agree. And I think renters are becoming more cognizant of the benefits of purpose-built rental because of some of the challenges in terms of how individual condo owners treat their tenants, or some of the challenges if they sell the unit and then now you're out of a home.
And willing to pay a premium for it.
Okay, so we're near the end of this. So final question with next year. Give me one opportunity and one concern that you guys have. Very brief, because we're near the end of this for 2023. Wendy, you want to start?
They're both housing. The opportunity is obviously to find whether it's some distressed pricing on a condo site to turn it to purpose-built rental, but to find sites for housing. And the concern is the lack of housing options bringing in our workforce, and these include people who work in our office building. So recovery of the office sector, building demand to fill up the space that we've built requires new people to come, and that requires housing. So the opportunity and the concern is housing.
Okay. Well,
I think the one risk, and this may be too macro, but I think the wild card is really around. It's geopolitical, but it translates into energy pricing, and I think that could be the wild card that keeps inflation a little stickier than I think where we expect it to be. So where we could see inflation stick around, call it 4 to 5%. The opportunity, I do think there's going to be some opportunities a little further up the risk spectrum in value add capital to put some of that to work in the new year as we see a bit more repricing, and I think we could see some more motivated sellers than we have to date. Don't expect any distress per se, but I think there could be some opportunities to provide some liquidity as sellers maybe realize the value of their assets has declined.
Okay, well, great. Well, thank you very much, Wendy and Phil, for your comments and your insights into our Altus Insight podcast. And again, thank you for joining us.
Thanks for having me.